Silver price alert. The economic crash has already started. Are you ready? Not next year. Not next quarter. Right now. While most investors are still waiting for a warning, the warning has already passed. There is one asset quietly doing something it has only done 3 times in the last 100 years. Each time it did this, what followed was not a recession. It was a collapse. That asset is silver. And what it is signaling right now is something that the world's most powerful financial institutions do not want you to understand, until it is far too late. Welcome to Financial Crisis Explained. This is the channel where complex economic forces are translated into clear, strategic intelligence for the business community, for aspiring entrepreneurs, and for every serious mind that refuses to be caught unprepared. Now, if you are the kind of person who has lived long enough to know that by the time something makes the front page, the smart money has already moved, then that subscribe button is not just a button. It is a decision to stay one chapter ahead of a world that is changing faster than most people are willing to admit. The ones who subscribed 6 months ago saw this coming. The bell icon ensures they will see what comes next. And before this analysis begins, one simple question for the comment section. Where in the world are you watching from today? Because what silver is signaling does not respect borders. It does not care whether you are in London, Karachi, Lagos, or New York. The crash does not check your passport. Drop your city in the comments below. This channel watches from every corner of this world, and so does this crisis. In the autumn of 2007, the global economy looked, by almost every visible measure, perfectly stable. Stock markets were near record highs. Employment figures were strong. Consumer confidence surveys showed optimism. And the financial press was largely celebratory. 12 months later, Lehman Brothers had collapsed. Trillions of dollars in household wealth had evaporated. And millions of people across the world were asking the same devastating question: how did no one see this coming? The answer is both simple and deeply uncomfortable. Someone did see it coming. Several institutions did. A small number of informed analysts did. But the signals they were reading were not on the front page of any newspaper. They were buried in bond yield spreads, in silver's quiet upward movement, and in the kind of data that most investors never think to examine until it is no longer relevant. This is the architecture of a silent crash. And it is being built again, right now. To understand what is happening today, one must first understand a fundamental truth about the way economic systems fail. They do not break like glass suddenly without warning from a single blow. They fracture like old stone, slowly, quietly, invisibly, from the accumulation of pressure applied in places that the surface does not yet reveal. Economic historians call this phenomenon structural deterioration. It is the process by which the foundational pillars of a financial system, credit quality, monetary policy credibility, sovereign debt sustainability, and institutional trust, begin to erode simultaneously while the surface of everyday economic life continues to appear functional. This is precisely what was observed in the 18 months before the 1929 collapse. It is what was observed before the 2000 dot-com implosion. And it is what was observed by those with the analytical framework to see it before the 2008 financial crisis rewrote the economic map of the world. And today, every single one of those structural indicators is not merely present. They are flashing at the same time. Consider what has happened to global sovereign debt in the years following the 2020 pandemic response. Governments across the developed world injected an unprecedented volume of liquidity into their economies, not through productive investment, but through direct monetary expansion. The United States alone added more than $7 trillion to its national debt in fewer than 4 years. This is not a political observation. It is a mathematical one. When a nation's debt to GDP ratio crosses the threshold of 130%, history does not offer a single example of an orderly, painless resolution. Not one. What history does offer is a consistent pattern of what happens next. Currency debasement, inflationary surges that central banks cannot control without triggering the very recession they are trying to prevent, and a rapid, almost desperate rotation by informed capital into hard assets, into gold, into real estate where accessible, and increasingly into silver. This is where silver becomes not merely an investment story, but an economic intelligence story. Silver has functioned as a monetary metal for more than 5,000 years of recorded human commerce. But its modern significance extends well beyond its monetary history. Silver is now an indispensable industrial input, embedded in the solar panels being installed across Asia and Europe, in the electric vehicle batteries reshaping the global automotive sector, and in the semiconductor infrastructure that underpins the entire digital economy. This dual demand profile, monetary and industrial simultaneously, makes silver uniquely sensitive to the exact type of structural stress that the global economy is now generating. When silver begins to move in the specific pattern it is currently tracing, economic historians have learned to pay very close attention. Because silver does not speculate. Silver does not follow sentiment. Silver does not respond to headlines. Silver responds to reality. And right now, the reality it is responding to is one that most of the world has not yet been forced to confront. In part 2, the evidence already on the table will be examined, data point by data point, because the argument being made here is not theoretical. It is already written in the numbers. There is a particular kind of silence that falls over a room when someone finally says out loud what everyone in that room already knows, but has been too afraid to admit. That silence is not confusion, it is recognition. And that is precisely the silence that should fall over every serious investor, every business owner, and every entrepreneur watching this today, because the data that will be presented in this part of the analysis is not new. It has been sitting in plain sight in public reports, in central bank disclosures, in quarterly filings and sovereign debt registers. The question was never whether the evidence existed. The question was always whether anyone was paying close enough attention to connect it. They were not. And that gap between available evidence and public awareness is exactly where financial catastrophes are born. Begin with the one indicator that has preceded every major economic contraction of the last 100 years, without a single exception: the yield curve inversion. When the interest rate on short-term government bonds rises above the interest rate on long-term government bonds, the bond market, which is not driven by emotion or social media sentiment, but by the coldest, most calculating institutional capital on the planet, is communicating a single message with absolute clarity. It does not believe the future is safer than the present. The United States Treasury yield curve inverted in 2022 and remained inverted for the longest sustained period in recorded modern financial history. Longer than before 2008, longer than before 2001. The bond market was not whispering a warning. It was broadcasting one, and the majority of the public never heard it. Now move to the manufacturing sector, the physical backbone of any real economy. The Purchasing Managers' Index, or PMI, is one of the most reliable leading indicators of economic direction available to analysts. A reading above 50 signals expansion, a reading below 50 signals contraction. Across the G7 economies, the United States, Germany, France, the United Kingdom, Japan, Italy, and Canada, manufacturing PMI figures have been registering contraction not for weeks, but for months. Germany, historically the industrial engine of Europe, recorded some of its weakest manufacturing output figures in over a decade. Japan's export orders declined sharply. And in the United States, the Institute for Supply Management reported manufacturing contraction figures that, in any previous economic cycle, would have triggered immediate policy alarm. They did not, because the narrative being maintained publicly was one of resilience. But resilience built on consumer credit is not resilience. It is delay. Corporate credit markets are now beginning to reflect what manufacturing data has been indicating for some time. Default rates on high-yield corporate bonds, what financial professionals refer to as junk bonds, have been climbing steadily. The companies that borrowed aggressively during the period of near-zero interest rates between 2010 and 2022 are now refinancing that debt at interest rates 2, 3, and in some cases 4 times higher than their original borrowing costs. For many of these companies, the mathematics of survival have quietly become the mathematics of insolvency. This is not speculation. Credit rating agencies have been quietly downgrading hundreds of corporate borrowers. The downgrades are happening. The defaults are rising. The financial press covers each one individually, but rarely steps back to observe what they represent collectively. Collectively, they represent a credit cycle turning. And when a credit cycle turns at this scale, it does not turn gently. Now consider perhaps the most telling signal of all, what central banks and sovereign wealth funds are doing with their own reserves. Not what they are saying publicly, what they are actually doing. In 2023 and into 2024, central banks globally purchased gold and silver at rates not seen since the immediate aftermath of the Second World War. China's People's Bank added to its gold reserves for 18 consecutive months. Russia, India, Turkey, and a collection of Gulf sovereign funds accelerated their accumulation of physical precious metals with a quiet urgency that stands in direct contrast to the calm being projected in their official communications. These are not the actions of institutions that believe the current financial system is stable. These are the actions of institutions that are positioning themselves before the positioning becomes impossible. And silver, sitting at the intersection of monetary demand and industrial necessity, is being accumulated with a deliberateness that the spot price has not yet fully reflected. That divergence between what informed institutions are doing and what the silver price currently shows is not a mystery. It is an opportunity, but only for those who understand what they are looking at before the rest of the market catches up. In Part 3, the unique mechanics of silver itself will be dissected, because understanding why silver specifically is at the center of this story is what separates a reactive investor from a prepared one. There is an old Persian proverb that serious merchants once passed down to their apprentices across the trading routes of the ancient world. It said simply, never place your trust in an asset that only one kind of storm can validate. In other words, an asset that only becomes valuable under a single set of conditions is not a shield. It is a gamble. And yet for decades, mainstream financial advice has treated precious metals as exactly that, a single-purpose hedge. a rainy day asset, something you hold when everything else fails and sell the moment confidence returns. That understanding of silver is not just incomplete, it is dangerously outdated, because silver in the 21st century is not one asset. It is two assets occupying the same physical form. And understanding this duality, truly understanding it, not as a footnote in a precious metals brochure, but as a structural economic reality, is what separates those who will look back on this moment with satisfaction from those who will look back on it with regret. The first identity of silver is ancient. It is the monetary identity, the one that stretches back across 5 millennia of human civilization, through the Roman denarius, through the Spanish pieces of 8 that once financed the age of exploration, through the silver standards that governed global trade before the 20th century dismantled them one by one. In times of currency debasement, in times of institutional distrust, in times when the purchasing power of paper money erodes faster than wages can compensate, silver has historically absorbed that displaced value. Not because of sentiment or tradition, but because it cannot be printed. It cannot be created by a central bank committee sitting in a room making a decision. Its supply is governed not by policy, but by geology. And geology does not respond to inflation targets. This monetary identity alone would make silver relevant in the current environment. But it is the second identity that makes silver genuinely extraordinary in this specific moment of economic history. Silver is now one of the most strategically critical industrial commodities on the planet. A single solar panel requires approximately 20 grams of silver, not as a trace element, as a functional non-substitutable component in the photovoltaic cells that convert sunlight into electricity. The global solar installation capacity that governments across Europe, Asia, and North America have committed to over the next decade will require silver in quantities that current mining output, by even the most optimistic projections, cannot fully satisfy. The International Energy Agency has acknowledged this supply gap. Industry analysts have modeled it, and yet the silver price, as of this analysis, has not priced it in, not remotely. Then consider the electric vehicle sector. Every electric vehicle produced today contains silver. In its battery management systems, in its charging infrastructure interfaces, in its advanced driver assistance sensors. As EV production scales from millions of units annually to tens of millions, the industrial demand curve for silver does not flatten. It steepens. And alongside EVs, the semiconductor industry, which underpins every smartphone, every data center, every artificial intelligence system being deployed across the global economy, relies on silver-based conductive pastes and bonding wires at a scale most people never consider when they are staring at a screen. This is the second identity of silver, not a relic of the past, but a raw material of the future. Now hold both identities together and consider what happens when they activate simultaneously, which is precisely what is beginning to occur. On one side, a deteriorating macroeconomic environment is driving institutional and informed private capital toward monetary stores of value, pushing monetary demand for silver upward. On the other side, the green energy transition and technological expansion are creating an industrial demand curve that shows no structural ceiling. Two independent demand forces converging on the same finite physical supply. And here is where the analysis becomes most important for the serious observer. The silver market has a peculiar and deeply consequential feature that gold does not share to the same degree. A significant portion of what is traded daily as silver on major exchanges, the COMEX in New York, the London bullion market, is not physical silver. It is paper silver. Contracts, derivatives, and synthetic instruments that represent claims on silver that, if every holder simultaneously demanded physical delivery, could not be honored. Some analysts who have examined the ratio of paper silver outstanding to verified physical silver available for delivery have arrived at figures suggesting the paper market is leveraged against physical supply at a ratio that, in any other commodity, would be considered extraordinary. When confidence in paper instruments erodes, as it historically does during periods of financial stress, the demand for physical silver does not simply increase. It accelerates in a manner that the paper price mechanism is structurally unprepared to reflect in real time. The result, when it has occurred in previous cycles, has not been a gradual price adjustment. It has been a repricing event, sharp, rapid, and by the time the wider public recognizes what has happened, the window for positioning has already closed. Silver is not waiting for the crisis to begin in order to become relevant. Silver became relevant the moment the conditions that always precede a crisis quietly fell into place. And those conditions, as parts 1 and 2 of this analysis have established, are not approaching. They are here. In part 4, the final and perhaps most consequential question will be addressed. Not what is happening and not why silver is at the center of it, but what the serious, prepared, strategic mind actually does with this information before the rest of the world is forced to act out of panic rather than preparation. There is a moment in every major economic shift that historians, when they look back, identify as the last point of clarity, the last moment before the noise became overwhelming, The last moment when the evidence was visible, the options were still open, and the cost of action was still manageable, that moment is not recognized in real time by the majority, because the majority is still debating whether the evidence is real. It is recognized only by those who have trained themselves to act on pattern recognition rather than public consensus. And the uncomfortable truth that this analysis must now deliver directly is this: that moment is now. Not 6 months from now, not after the next Federal Reserve announcement, not after the next quarterly GDP revision. Now, but acting intelligently in a moment of economic clarity is not the same as acting impulsively. And this is the distinction that separates the serious decision maker from the panic-driven one. The first principle that historically informed investors have applied during comparable economic junctures is the principle of portfolio reweighting toward real assets, not abandonment of all other positions, but a deliberate, calculated shift in the proportion of capital allocated to assets whose value is anchored in physical reality rather than institutional promise. Paper assets, stocks, bonds, currencies, and their derivatives derive their value ultimately from a chain of institutional trust. They are worth what they are worth because enough people and institutions collectively agree that they are worth it. That agreement is remarkably stable during periods of systemic confidence. It becomes remarkably fragile during periods of systemic doubt. And systemic doubt, as parts 1 and 2 of this analysis have demonstrated, is no longer a theoretical future condition. It is a present and measurable reality. Real assets, and silver specifically in this context, do not derive their value from institutional agreement. A silver bar sitting in a vault in Zurich or Dubai or Singapore does not require a counterparty. It does not require a functioning clearinghouse. It does not require a central bank to honor a commitment. It simply exists. And in a world where counterparty risk is quietly but measurably rising across the global financial system, that unconditional existence is not a minor feature. It is the entire point. The second principle is the critical distinction between speculative silver exposure and protective silver exposure. These are not the same position. They are not even the same decision. Speculative silver exposure, purchasing silver mining stocks, silver ETFs, or leveraged silver futures contracts, is a bet on silver's price movement. It carries the full spectrum of paper market risk. A silver mining company can be mismanaged. An ETF can have counterparty exposure that its prospectus buries in footnotes. A futures contract can be liquidated at precisely the wrong moment by a margin call triggered by broader market volatility. These instruments have a role in a sophisticated portfolio strategy. But they are not the same as holding physical silver directly. Protective silver exposure, physical coins, physical bars, held in allocated, segregated storage or in direct personal possession, removes the counterparty entirely. It is not a trade. It is a structural decision about the form in which a portion of one's wealth exists. And in the current environment, the distinction between these two forms of silver exposure is not a technical detail for precious metals enthusiasts. It is a strategic decision with real consequences for financial resilience. The third principle, and perhaps the most psychologically demanding one, is confronting the cost of inaction honestly. Human beings are extraordinarily skilled at constructing rational-sounding justifications for remaining in a comfortable position. Recency bias, the cognitive tendency to assume that conditions recently experienced will continue, is perhaps the single most destructive force in investment decision-making during the early stages of a major economic transition. The investor who watched markets recover after 2009, after 2020, and after every other moment of apparent crisis has been trained by experience to wait, to assume that recovery follows disruption automatically, that central banks will intervene, that governments will find a solution, that this time, as it has always seemed to be, will not be the time. But history does not offer unlimited repetitions of the same outcome. And the structural conditions that exist today, the sovereign debt levels, the yield curve signals, the manufacturing contraction, the institutional accumulation of hard assets, and silver's unique dual demand dynamic represent a combination that is not previously resolved without significant economic pain for the unprepared. The question this analysis posed at the very beginning was direct and personal. Are you ready? Not ready in the abstract. Not ready in theory. Ready in the sense that the decisions which preparation requires have actually been made. The information has been available. The pattern has been visible. The signals have been consistent. What has separated those who will navigate this period with their financial foundations intact from those who will not is not access to secret knowledge. It is the willingness to take available evidence seriously, before the cost of doing so rises beyond what most people can afford. The economic crash has not arrived on a front-page headline. It has arrived the way every serious crash has always arrived, quietly, structurally, and ahead of public recognition. Silver is not predicting this. Silver is reflecting it. And the gap between what silver is reflecting today and what the broader market has yet to price in represents one of the clearest strategic windows that serious observers of economic history have seen in a generation. The window is open. It will not remain open indefinitely. And the only question that remains, the only question that has ever truly mattered in moments exactly like this one, is not whether you understand what is happening. It is whether you are prepared to act on that understanding before the rest of the world has no choice but to